Good morning, trading world. Today is June 17th, 2022, and this is my pre-market outlook and technical analysis for day trading the SPY. Today is triple witching day, or triple expiration day. The definition from Investopedia is as follows. Triple witching is the simultaneous expiration of stock options, stock index futures, and stock index option contracts all on the same trading day. Because three option classes that could share the same underlying securities expiration all on the same day, it can cause increased trading volume and unusual price action in the underlying assets. Per Investopedia, so this gives us higher than normal chance for a gamma squeeze one way or another. One of the reasons I'm talking about a temporary tradable bottom is the fact that the weekly and the monthly chart are approaching their exhaustion points. Remember my analogy of the market being a runner in a marathon and how no runner can run forever. They have to slow down at that planned water break area along the route. At a marathon, a runner will often slow down and kind of run in place while they rehydrate. Same is true for markets, only the slowing down and rehydrating equates to consolidation over a range. This is why you get that rapid up, down, up. I call it consolidation patterns, but Investopedia lists them as continuation patterns. Things like wedges, triangles, and so forth. Investopedia also goes on to separate them into two classes, continuation and reversal patterns. These consolidations happen all the time on smaller time frames where the ranges are insignificant. However, when it happens on a weekly or monthly price range, it's usually massive. And team that up with high volatility, and you are covering vast ranges that usually take weeks to months to cover in a matter of hours to days. Because of this, I wouldn't be surprised if we cover an entire volatility channel today. That current channel is down to 364 all the way up to 379 on the SPY. Give me a moment and let me bring up the key levels for today. Alright, here we are with the key levels of the day, starting on the resistance side. We have our jack resistance from 369 up to the 370 area. Then we have our queen resistance at 371 up to the 373 area. And then king resistance at 374 to the 383 area. On the support side, we have jack support at 368 to the 367 area. Then queen support 366 to the 364 area. This 364, if we come down, it's going to be hard to pierce through. But if we do pierce through it, look for some very scary and violent, well, not some, but a very scary and violent burst down to this 358 area and possibly a little below it. Then we get to our king support area, 363 down to the 358 area. The main thesis for today, it is bearish, closing below the 365.07 with a projected target low of between 365 and 361. The alternate thesis is bullish, closing above the 365.07 with a projected target high of between 376 and 383. One thing I like to remind you of, when we get short squeezes, it's usually because order flow, or a majority of the order flow, is sitting on one side expecting one thing, and we get that extreme reaction that everybody's kind of unprepared for, which is that opposite reaction, which in today's case would be the bullish alternate thesis. And when we get that alternate thesis in this scenario, it is usually way more explosive. So even though quant statistics are pointing us toward a bearish biased market today, fundamentally there is a chance for that huge explosive opposite move. And this is usually what happens in a gamma squeeze. Today may be the beginning of a huge volatility box kicked off with the gamma squeeze. Internals are ripe for a huge pop up, as they still have not repaired from a huge gap down from yesterday. The box in thirds from 2 days ago that I showed is still in play for today. And at some point, the trend channel that I keep pointing out, we will test it. I'll bring that point back up after the drawings because I don't want to erase my levels right now to show that on the chart. The current channel we are in is, well, the major channel is 364 up to 379. The next major channel is 364 down to 353. Keep in mind, if we go up, the next major channel is 379 all the way up to 397. That brings us to the scenarios for the day. All right, our first scenario is our trend day up day structure, which means we open gap up from the previous close represented by the blue line. We start to fade back toward that previous close, but we find support on or before that previous close, then begin the uptrend for the morning, which is known as the golden window. We find midday chop around either the possible queen or king resistance area, and that's pretty much our trend day up structure. You want to get trades on during the golden window, which is usually the strongest trend of the day. Let me bring up scenario number 2. Scenario number 2 and scenario number 1 today are a toss-up. They have about the same probability of happening, and this is due to volatility. We are still in an elevated state, but we're up and down in that elevated state, which keeps taking us to the brink of some very fast price action, meaning a drop off, because we are pretty much standing at the edge of a cliff. But when it comes to scenario number 2, it is our expanded range day structure. We could look to set a decision area low boundary around the jack or queen support area before starting to rally for the day. And that's going to look quite similar to our trend day, but somehow we're going to fade, find a little support, get our head fake, and then there will be a quick swoon down to that jack or queen support, or possibly a little bit below. We'll have to keep our eyes on volatility to see how high it flashes during this drop, if it does happen. And then we're going to get a huge rally coming off of that. So that's one of the ways that I see this expanded range day structure play out. Remember, again, range days are the hardest to diagram because there are so many different possibilities that could take place. There's so many different ways that you could bounce between 2 points when it comes to a range day. So that's scenario number 2, our expanded range day structure. Let me bring up the last scenario. Alright, scenario number 3 is our rounded reversal day type structure. We could get a continued push higher toward the jack or queen resistance area and find midday chop either around that queen or king resistance before spending the same energy we use going up in the morning to come back down the second half of the day. Our rounded reversal day type structure comes with a huge vice versa warning because we could look to see something like this today when it comes to our rounded reversal day type structure. We could end up trailing off and getting that continued push lower toward the jack or queen support area before turning around and using the same type of force we came down with to go back up the second half of the day. So that's the rounded reversal day type structure. So be very careful of the vice versa warning for it. There was something that I wanted to go back over. Let me erase the drawings. All right. There was something that I was saying in the middle which I couldn't really illustrate on the chart about the box and thirds that we used a couple of days ago, how it is still in play. I just want to bring that up. And this is pretty much still in play. I'll bring it forward for today, but this absolutely still plays. So if you want to get long, you best do it down here in the lower third. Stay out the middle, because today this could really play at 70 miles per hour. You could really get run over in here today. Also, we are going into a 3-day weekend. So be very careful. I don't think a lot of people will want to go in long over the 3-day weekend. So that's going to help with this increased push up for people rolling out positions past Tuesday. So just a reminder, it is a 3-day weekend. Markets will be closed on Monday to celebrate Juneteenth. But I wanted to bring up the box and thirds, and then I also wanted to show you we've been holding this channel very strong. This is the middle of a trend channel that I use. It's a Andrew's pitchfork drawing that I use to keep up with the actual trend channel that we're in. And I am expecting us to test, which we did come very close to testing yesterday, but I do expect us to test the bottom of this at some point and push up and get us back to the middle or close to the middle of this trend channel. So that was it. I hope the information helps. Again, as always, please understand your risk. There is no reason, if you're going to go long in the volatility box, there is definitely no reason to take on risk below this area, because once this channel breaks, all hell is loose. So you don't want to hold on to any positions or long positions and risk once this channel breaks, because this could really begin to drain your account from here. Like I said, we're on the edge of a cliff, and this is basically the edge of that cliff. So and on the same to the upside, when it came to the volatility channel, you don't want to limit your risk. If you're going short in the upper third, there's no reason to take on risk above this area. Again, I hope this information helps you in your trading. I really appreciate the feedback and letting me know how much this helps. It's one of the reasons I continue to do it. As always, wishing you a positive trading day. Have a great one.